Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. We've talked a lot about the banks in recent days as they report their half-year results. Across the four major banks, headline cash earnings came in at $14.4 billion, up about $700 million from 12 months earlier. But the banks are now entering a different environment altogether, with interest rates rising last week for the first time since 2010. Tim Dring is the Oceania Banking and Capital Markets Leader at EY. Tim, welcome back to Fear and Greed.
Great. Thanks for having me on, Sean. Great to be here.
So how would you say the banks are doing? Their half-year results, we've had National Australia Bank, ANZ and Westpac. 3 months ago, we got Commonwealth Banks. What's the state of the banking sector, do you think?
Look, I think it's looking pretty strong, Sean. I think you've highlighted there, $14.4 billion in aggregated earnings for the 6 months. That's about 5% up on the corresponding period. So a pretty good result from that perspective. But when you think about some of the challenges they've been dealing with as we start to live with COVID, we are seeing that ongoing compression with margin. And that has plagued the banks for many years, to be honest. And we're down to 1.75% net interest margins. That's the difference between what they can lend money for and what it costs them to fund those loans. Now, that was down 14 basis points. So once again, that margin has been compressed.
Yeah, there's a bunch of things here. So let's start with the net interest margin. That has been going the wrong way for banks for a long time, though. Is this the opportunity for them to turn it around because rates are rising?
Look, it certainly gets harder to manage margin in a decreasing rate environment. And, with the cash rate being the lowest in history, that has been a very big challenge. As we've seen that, the cycle is starting to change, rates will be on the move up. That should make it a little bit easier to get some margin expansion. There's probably a couple of things in there, Sean, worth unpacking. So we saw through the crisis a number of borrowers switching banks, refinancing, etc. Competition has been intense. So that has put pressure on margins. And as I said, as rates start to move up, you'd like to think there's some expansion, but I think competition is going to be with us for a while. And that is something the banks really need to tackle and think about how they can deal with that more effectively.
So just on that, are mortgages the most profitable part of banking?
Look, they are, for banks, the banks at scale, like the big four banks, they are profitable, probably for a couple of reasons. One is the amount of capital required for mortgages, and obviously for the bigger banks, that's driven by their models as they're advanced accredited banks as opposed to the standardised for a number of the other banks supervised by APRA. So therefore, the amount of capital they need to hold against a mortgage is typically a lot lower than what it would be for other lines of business they're in, whether it be in business banking or in institutional banking. So from that perspective, there's a capital advantage in writing more mortgages. So, they are profitable. The more loans they write, the more profitable banks are. And I think that is one thing they have focused on. Whilst margins have been compressed, it's sort of that price-volume equation. How do we get more volume through the door? And, we have seen growth start to pick up a little bit through the last 6 months. Some of the institutions, are running at system or just below system, but we are seeing some reasonable credit growth starting to come through. So, that's helped sort of combat and mitigate some of that margin decline.
Okay, so we've sort of gotten into the weeds a little bit already. I just want to take a step back now. If you're comparing the banks in terms of return on equity as a very broad-based measure of how they're doing, where are they at today as opposed to a couple of years ago?
Yeah, look, the return on equity, is a key measure in looking at bank performance. And, we have seen, through COVID where that has taken a bit of a hit, and a lot of that was due to the build-up of provisions that the banks had established. It's probably started to settle down now, and it's sort of in that low sort of 10 to 11 mark, but it's well down from the highs when the banks were very profitable. And, the highs, 14, 15% ROEs were achievable. Now, against the global standard of ROE, our banks still compare pretty well, but they're far from the highs they have been historically.
Okay, so a couple of things in that. The credit impairment charges, it seems that the banks are more confident about not having as many bad loans going forward because that has helped their results this time round. But with rising interest rates, isn't that a risk?
Look, very much so. I think they have seen their books hold up very well, unbelievably well, if you like, through COVID. And we are starting to see a number of the banks sort of wind back some of those provisions that were built up. In aggregate, we did see, almost a 200 mil net gain, net write back, if you like, of provisions for the last 6 months. But there are some headwinds, and I think some of those factors they are looking to take into account and have been modelled even in the last 6 months through the provision being struck in the last half. Because they are looking at sort of some of the downside risk factors, those broader economic overlays that the banks put in their provisions to effectively provide for things that they just don't know about yet, some uncertainty that will occur. And you touched on rising interest rates. That has been factored into their economic adjustments and overlays. What that does to asset values, collateral values, and the economy as a whole. Does it reach a point where things start to slow down? We've got rising inflation and rising interest rates, and what does that do for mortgage stress or asset stress? So I think they are starting to factor some of those in, but early days on that cycle. So it will be interesting to see how that plays out over the next 6 months and beyond.
Stay with me, Tim. We'll be back in a minute. My guest today is Tim Dring, the Oceania Banking and Capital Markets Leader at EY. Costs are another big area for banks, and ahead of the pandemic, it seemed to be the way for a bank to be successful was to cut costs. The pandemic hit, but now we're back to let's cut costs. If we look back over the last week, Westpac is the standout in terms of at least investors' view on what they're doing around costs. Having said that, the benchmark for Westpac was probably a lot lower than some of the other banks. It's not that easy, though, to cut costs, is it? Because it's not just about branches and people. It's about, legacy systems and regulatory impositions post-Royal Commission and cybersecurity, etc.
Exactly. And running a big bank is a challenge. And, we spoke about the pressure on margins. The other thing they've been really trying to do, Sean, is take costs out of their business. And, they've been able to achieve some cost savings in the last 6 months. Cost to income ratios had slightly improved, down from 51% to 48.5%. But there's a lot of costs that go into that bucket. Labour is somewhere between sort of 2/3 to 3/4 of a bank's running costs. The technology spent, not only in maintaining legacy systems, but frankly keeping up with the bank over the road or the bank over the street, or
social media company.
Yeah, or the emerging competitor that may pop up. So they need to be nimble, but consumer preferences are changing. Things are moving more to digital. We've seen them streamline a lot of processes, take out complexity, and when you do that, you're well on the way to taking out costs out of your business as well.
Okay. Now, you're talking, if we look ahead here, it's something that I know you're very interested in is the whole build-to-rent concept, and you do believe it's gaining some traction. Is that right?
Yeah, that's right. I think, there is certainly a housing shortage across most capital cities at the moment, and we are starting to see that put upward pressure on prices.
Just explain build-to-rent.
So build-to-rent is effectively a scenario where you will have investors come in, typically large-scale investors, and some of the research we've done overseas, whether it be a superannuation fund, pension funds, or managed funds, come in and buy big parcels of land and build effectively accommodation for either low to medium density housing and affordable housing. So we are seeing that as it is a bit of a global trend. Perhaps Australia is a bit of a late adopter to it, but we see that as something that could go to some way to arresting some of the housing shortages that do occur in this country and really provide a return for some of those investors as well and meet the needs of perhaps some of those home buyers that can't get into the market when they are looking to acquire either their first property. Particularly the big component of any house is the land component, and effectively using a fund or a developer's balance sheet to effectively take that high cost out of it, we think is something that has real possibility in this country.
Okay, but if the super funds are getting into that area, does that potentially cut the banks out, or will the banks still be the people lending the money?
It could be an element of both here. There could be some, I'll call it equity financing, that may come through some of the super funds or other investors, but banks can play a critical role in providing some of that funding as well, just finding the right funding mix. So I think it's both an opportunity for investors and also a big opportunity for financial institutions as well to play a role in part of that rebuild, if you like, which is a market they may not have played in. So there could be all winners around in this one.
The next thing I just want to ask you about is talent. I mean, who wants to work for a bank nowadays? Well, that's probably a bit unfair because I think they probably are great employers, but they've kind of really changed how they approach employees because they have to.
Well, that's right. I think we are seeing the demand for talent right across all sectors and right across the globe. It's quite an amazing phenomenon, the situation we're in with the labour shortages. Banks are changing. The talent they require today is very different from the talent they required 10 years ago, 20 years ago. We are seeing the demand for talent, particularly in IT, programmers and analysts, the demand for talent in data, and also the demand for talent in risk. And I think that's been a bit of an ongoing theme for a while as banks, whether it be large or small, rebuild their businesses, particularly around managing risk and customer outcomes. So it's a big issue for the sector. And if we think about labour as such a significant cost to a bank's cost base, there has been some upward pressure on that. And probably we will see some more upward pressure on salaries and wages in the short term at least.
Just to wrap up, where do you think the Australian banks sit today, the big four banks, vis-a-vis where they were 10, 20, 30 years ago? Certainly a more competitive marketplace.
Look, it is definitely a more competitive marketplace, and we're seeing that play out in pricing and customers getting better outcomes from a financial perspective. I think it's a very different marketplace what customers are able to access now from a technology standpoint. I think the banks are really starting to get much better at actually understanding the data and their customer profile, in understanding that customer profile better, being able to make sure they are selling and providing the right products tailored to those customers. So automation is playing a key role in that. The key essence of banking is effectively providing credit and making credit decisions, and we're seeing technology play a big role in that as well, Sean. But having said that, the skills of being a banker and providing credit, particularly in business banking, institutional banking, some of that can be automated, but some of that does require, significant skill in credit assessment processes. So there's some things perhaps haven't changed, but there's probably more that have. And going forward, I dare say there'll be more change on the horizon as well.
Tim, thank you for talking to Fear and Greed.
You're welcome. Great to be with you.
That was Tim Dring, the Oceania Banking and Capital Markets Leader at EY. This is a Fear and Greed Daily Interview. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.